Hello, and welcome to Your Estate Matters with your hosts, my colleague Greg Bernand and myself, Nicole Garten of Heritage Trust.
Your Estate Matters is a podcast dedicated to everything estates, including building and preserving your legacy.
If it's estate related, we'll be talking about it. We're having the conversations today that will help Canadians protect their families, their assets, and their legacies tomorrow.
Brian, thanks for being here with us today. Tell us about yourself and your journey to your current role at Watershed Financial.
Well, thanks for having me, first of all. My journey to becoming a financial planner has been both unique and enriching. Mm-hmm. Early on, I spent several years in the video game industry where I learned the importance of strategy, long-term planning, and innovation, skills that I now apply in developing strategic financial plans for my clients. From there, I guess I transitioned into real estate, working closely with clients to help them achieve their homeownership goals. And this experience gave me a deep appreciation for the value of strong client relationships and attention to detail, both of these which are critical in financial planning. Mm-hmm. Over the years, I earned designations such as the Chartered Life Underwriter and Qualified Associate Financial Planner. This equipped me to offer tailored solutions for business owners, high net worth clients, and families. Founding Watershed Financial Solutions was a natural progression, allowing me to provide a level of personalized service that combines the sophistication of a large institution with the care and attention of a boutique firm.
Mm-hmm. So why should Canadians prioritize financial advice?
Well, financial advice, it offers Canadians a roadmap through complex decisions, from investments and insurance to estate planning. Insurance serves as a foundation to this roadmap, providing protection and security that underpin successful financial plans. Professional advice is crucial because it can optimize taxes, preserve wealth, and ensure the financial goals are achievable within the context of each client's life. In today's economic environment, tailored advice provides some peace of mind and helps Canadians protect their hard-earned wealth while staying on track towards their long-term goals.
Brian, what sort of financial product should people consider as part of their estate plan?
Well, estate plans often benefit from products like life insurance, segregated funds, or sometimes they're often called guaranteed investment funds, and also trusts. Corporate-owned life insurance, for example, can provide tax-free death benefits, creating liquidity for taxes owed on estates or on shares, and then passing wealth efficiently to their heirs. For individuals, segregated funds offer benefits like probate avoidance, privacy, and direct beneficiary designations, which can simplify estate transfers. Mm-hmm. Additionally, for some, creating trusts may streamline the estate distribution process while preserving privacy and some control. Mm-hmm.
So, Brian, tell us about segregated funds. I don't know if our listeners are necessarily familiar with them. What are they, and what are some of the main reasons why people might use them as part of their estate planning?
Well, what we in the industry like to call them is, the insurance company's version of the mutual fund. Mm-hmm. It has wrappers, so those would be the guarantees, but the underlying asset is a mutual fund. And so the word segregated fund, it just comes from the idea that they're segregating out, the company is segregating out those assets apart from their operating income. And so it protects the investor.
Right. So now, many years ago, I think when these first came out, they offered some creditor-proof protection. Mm-hmm. And also, I think in the case of family separation, there might have been some segmentation there. Is that still true?
Yeah, they offer creditor protection specifically if you name your beneficiaries, they're part of your immediate family, and you maybe put them in as irrevocable beneficiaries, meaning they need to be needs to be signed off. Any change would have to be signed off from the beneficiary to make a beneficiary change, for instance. Mm-hmm. In the case of family litigation and things like that, they're often used in that way for not just creditor protection, but for control of where that asset's going. So it can't be changed down the road. Yeah.
So if you name a designated beneficiary, that sounds like a good way to save probate fees, but isn't it true that the management expense ratio or the fees are quite high for segregated funds?
Yeah, they used to be in the early days, but with lower guarantees, like there's a few different levels of guarantee, but the lowest would be 75% on maturity and 75% on the death benefit. With that, there is going to be lower fees overall, and more to mirror more what is happening with the mutual fund.
So what do you mean by a guarantee?
It means that as an example, if we were to invest $100,000 in a 75 guarantee contract, 75% of that principal would be guaranteed. If you were to pass away, and also during your lifetime, if you stayed with the company for a set number of years, those guarantees on the maturity kick in. So there's two parts to that guarantee, maturity and the death benefit.
Does that mean if there's a big market correction, you could only lose 25%?
Yeah, so a good scenario that showcases that might be a 71-year-old had $100,000 in. He wants his income in retirement, but now the market has gone down, big correction, like imagine 2008. He would be worried about his money. Well, if there was a 75% guarantee, $75,000 of that principal would be guaranteed. Or if the market increased and it was above the 100,000, he would get that market value. And so that insurance company will top up. So if it went down to $50,000, and the insurance company would throw in another $25,000.
Yeah, if they were liquidating,
Yeah.
or such. Now, is there any time that a client can reset what the 75% is?
Yeah, often those lower guarantee structures don't offer a reset, but you would have to move to possibly a 75-100. So, which is quite popular with the aging population, because if they were to pass away suddenly, they want that principal 100% protected. Often in those contracts, you have the option to, check the box, for instance, on having a reset maybe every 1 year, every 3 years, every 5 years. And those fees for those products would increase with the more things that you want to add to it, right?
So how common are these? Because I don't hear about them very often.
Well, what we've been seeing in the industry is a lot of advisors who are on the mutual fund side have been leaving to go to the seg fund side, and especially if their clients are older, and they see that as a benefit. But yeah.
What are some good resources available for people to learn about finances and estate planning?
Well, Greg, a great starting point for learning about finances and estate planning is consulting with your financial advisor. And they can provide tailored guidance and resources, and often available on their website as well, are additional resources. At Watershed Financial, we prioritize client education, and hopefully we're building some peace of mind along the way. Other valuable resources could be like Heritage Trust Company's website, which offers an estate organizer guide, as you know. Books like The Wealthy Barber Returns by David Chilton is a good read. Atomic Habits by James Clear. That one speaks to a lot about doing the small things it takes to get ahead and do the right things. And then Smart Couples Finish Rich by David Bach. Other than that, additionally, government sites like the Financial Consumer Agency of Canada, they provide reliable, up-to-date information on personal finance basics.
So if someone is Googling, what might they need to be aware of? Is there a lot of misinformation out there?
There can be. They should really check their sources, and that's why having a financial advisor who can, tell it to them straight, fact check for them, get back to them, And then even through the client annual review process, we are always going through material that helps them grow a little bit more. Their investor profile, we always go over each time we meet to ensure that's the same or better or different. And
So in the planning process, there used to be a fairly big business in the annuity business. Is that still something that's offered?
yeah,
part-
there is a need for annuities. Pensions are annuities. And so those self-employed people who feel a need to cover those expenses in retirement might benefit by or feel assured that their money is going to be there for those purposes. And so they might buy an annuity, just lump sum an annuity. And these days, newer annuities come out with deferral periods where you put the money in, let it grow for a number of years, and then take it out maybe in 10 years. Gives it a chance to continue to grow before you take it.
I think one thing people struggle with is there's a lot of different designations and titles for people that offer financial advice, and I find it, even working in this industry, difficult to distinguish who does what. Could you explain what the different types of financial advisors are and the credentials and how people can identify who would be the right person for them?
Yeah, sure. I can cover off some of that. And, the LLQP, for instance, is where I started. It's a life license for living and death benefits. Would be your disability, critical illnesses, life insurance, long-term care. It moves into dental benefits, group benefits as well. It can branch off from there. Then you continue on, study financial planning, your QAFP, Qualified Associate Financial Planner. And then the next level up from there is the CFP, Certified Financial Planner. The CLU, Chartered Life Underwriter, covers a lot more on estate planning. Working with trusts, businesses, succession planning, covers a lot of material. All of those cover a lot of material and take time to get your designations. But then there's also the tax and estate specialists, the TEP, and CFAs. Then you're getting into more of the financial analysis, and of course the CPAs and accountants and things that are all kind of form part of a team anyway. When we are working with clients, you have your lawyer and accountants.
And these all stemmed from the different industries not being able to compete against each other years ago. So the education comes from the insurance side, some comes from the bank side, some comes from the brokerage side.
Well, the Bank Act, Greg, it even stipulates that the bank, like any of the major banks, they might have the bank side and then they might have the insurance side of the same bank. Well, they're not even allowed to refer work to one another because of the Bank Act. And so you'll go to the teller and they might have a financial advisor, and they might not have the credentials that we in the industry would consider a financial planner anyway, or a financial advisor. It's more a looser term. Yeah.
So how does somebody get started? They haven't started coming up with a financial plan. How do they figure out who to call?
Yeah. You could start with the carriers, or even let's just talk about like Financial Planning Canada, FP Canada. I go on their website. They'll have a listing of people. Insurance Council of BC also lists licensees and their credentials. So you could start there. If you have your parent, maybe if you're getting started and they have a financial planner, you could ask them about them and then look them up and just have a meeting with them. What does your gut say? Do you want to meet with them further? And then look up their credentials and ask them about their clientele. Those types of questions.
So often you would get, say, a product supplier selling a life product, perhaps. But then as you speak to the client, you find out they have much more comprehensive need for a plan. Like it's rather than just a product,
Right.
they need a plan. and look at the whole thing. And I think everybody's like that. Investment advisor sells a stock, then realizes there's far more planning required here.
Yeah, like was mentioning earlier, the protection and security of the insurance is the underpinning of a good financial plan, because you could save for years and have this money saved for retirement, but an event happens that you would then need to fund, and that money is coming from your retirement income, and you don't want to drain those coffers. So insurance, put the risk on the insurance company, pay the premiums, and then there's term insurance, there's whole life insurance. There's a lot of choice out there.
Right.
So as insurance advisors, you really have to see where the client's at.
Right. And most people don't realize the sooner you put it on, the cheaper it is
Yeah,
for your long-term rate, right?
correct. Yeah, like even for my children,
Yes.
early on, I got them insurance, and I pay for 20 years a whole life insurance, and one day they'll use that. They could access those funds, and they can will that to their children, or
So do you want to
yeah.
explain to people there's different types of insurance? Like, do you want to say, like, what is term versus whole life, for example?
Sure. Well, term insurance is a type of insurance that does not accumulate a cash value. So it's just the death benefit is the main thing you would be getting by paying your premiums. If it's a term 10, that means it's level pay for 10 years. So if you were paying a premium of $100 a month for 10 years, in 10 years, if I was 20 when I started and 30 at the end of 10 years, well, now the insurance company would raise the premium on a schedule that you would then see at the beginning what that price would be. You would raise that up to the next as if you were 30, but you add a little extra for the risk the insurance company takes on by not knowing any change in your health. So quite often as advisors, we would go to someone and say, well, we should, if your health is the same, we could look at your a new policy, and it might be less expensive than what you would go into on an automatic renewal. Yeah.
Right. Instead of a continued term 10, initiate a new term 10.
Yeah, or
based
term
on the health,
20.
or 20 or something.
Like I often will see people, they start the starter policy is the term 10. And then maybe by the time that's done and they need a term 20 to take them to the end of their working life. And if they have wealth or enough sufficient funds, they may consider converting to whole life if their health is taking a turn, or get a new policy that's whole life and with some term to it. So we can tailor make these solutions to fit the client's budget and need for life.
But do you want to explain to our listeners what exactly is whole life?
Well, whole life insurance is a permanent insurance, and in some cases you can overfund it. So it's beyond the cost of the insurance. You're adding funds in there every year, and those funds attract dividends, and so the company would pay the dividends every year, and it's locked in every year. And it would grow over time. You could access the cash value in a couple ways, either through policy loans or leverage from the bank, or surrender, partial surrender. And then you can access those funds for any reason at all. And it's not considered earned income, which is great for a retiree who wants to just do a top up. Maybe after 20 years, there's substantial cash value there. And they can do that. And then if they passed away, the outstanding loan would just be paid to the bank, and the beneficiaries named would get the remainder.
So who would be a typical client that would purchase that? Like, what type of person would seek that?
Yeah, well, usually you'd want, on a whole life product, you'd want someone with a bit of a runway, unless they had substantial wealth and company and things like that. But
you mean young?
Younger.
Okay.
Like
Years left.
Yeah, they're not going to be 30 usually, because it's largely, it could be unaffordable. and they might have young family, they might have a lot of expenses and a big mortgage and things like that. But 50, around 40 to 60 would be the age range. And then if they're company owners, there's benefits to that. Liquidity is the big thing with whole life. And then there's universal life as well, which is it's different there. A lot of bells and whistles, a lot of features you can turn on and off. But also it could be like minimally funded, just very basic, and then turn on the investment portion some point after it's done. So there's some differences there. Yeah.
So there's people that are just getting started, but what's quite common I notice is that in a couple, one of the couple usually was sort of in charge of the finances, and if they pass away or lose capacity, the surviving spouse is sort of left. What do you recommend someone like that? Like, say the husband managed the finances and he passes away and the wife is 70-ish. How does she find somebody with integrity that's going to be acting in her best interest? What would you recommend to somebody like that?
A trusted family member who maybe has a financial planner, and who they see that they've had some success doing that, and maybe a long-standing relationship with their advisor. That could be very good for them, and these people kind of need help along the way, and they should have someone they trust.
And can you also tell us, there's some people that charge by the hour or fee for service, and then there's some people that charge as a percentage of assets. Like, what are the differences and the pros and cons of each one?
Right. The people like myself, we charge based on the products that we sell. I can change that whenever I want, but because you have to have a designation to do that. Earlier on, I had to do product-based commissions and things like that. So with that, I mean, they're giving advice and they're hoping that you buy these things. But the longer you're in the business, you don't end up looking at what the commission is. You're just finding the solution for people and let things happen as they may. But some people believe that they want to just do fee for service. They don't want to worry about the commission. And if you invest with them, they'll take a yearly fee, or they'll pass off the insurance to someone else that would just be commission based. They're more interested in the estate, like the financial plan or the estate plan that they're going to do.
So some are product based, some are fee based, and then don't some people charge as a percentage of investments that they manage?
That's right. Yeah. So I recently put some people over. I recently referred people to High Net Worth, and they charge a yearly fee on so much assets, and then they are free to make trades more often. They don't charge for those things. They also provide them maybe with some professionals who could give some investment advice or some financial planning advice. But in this case that I referred them, I'm still the planner, so we work as a team.
And is that a portfolio manager?
That's like a high net worth, discretionary funds, that type of thing.
So what's the difference between a portfolio manager and someone who's not?
They're specific to investments and managing fund. They're not. They're managing a portfolio. They're not the fund manager. Like, they're not making the day-to-day trades, but they quite often will pool together a number of funds to make an in-house product that is made up of maybe different funds that are available in the market to everybody, but they've packaged it a certain way, and so they're running that portfolio in that way. And they're also getting, like, they'll review and then take some out and put some in every year and make sure they're performing correctly.
But isn't there a distinguished between someone who can trade unilaterally or they need your permission? Isn't there a difference?
Oh, I see what you mean. Well, we can get authorization. The client can sign a form and give you authorization to make the trades. It just depends on the relationship with the client.
Okay.
In the managed money space,
Right.
you would
Yeah.
sign a discretionary agreement.
Yeah, I even do that with clients where I don't need a signature for everything that we do.
Right.
Yeah.
So, do you have any final tips for people looking to get their finances organized?
My parting advice would be to start early and be proactive. Because even a few small steps can have a substantial impact on your future financial well-being. I would regularly visit your plans. I'd adapt them to your life's changes. I'd seek advice as your needs evolve. Financial planning is less about products and more about creating options and flexibility for your future. And once you've established your wealth, it's equally important to focus on estate preservation and transferring assets to the next generation. But working with a team, your financial planner, your tax accountant, your lawyer, and possibly a trust company can ensure a smooth and effective legacy plan.
Brian, how can our listeners find you?
Well, listeners can reach me at watershedfinancial.ca, either through that website or by phone. We're based in Delta, BC, and I'm always available for consultations and to answer any questions. I look forward to helping more people improve their financial health and achieve long-lasting financial peace of mind.
Thank you for coming in.
Yeah, thank you so much.
Thank you for having me. I appreciate it.
Terrific.
This podcast is for informational purposes only and should not be considered individual legal, financial, or tax advice. Make sure to consult the advisor of your choice to advise you on your own circumstances. Thank you for joining us for this episode of Your Estate Matters. If you like this podcast, make sure to follow it on your podcast platform of choice.
Whether you are planning your own estate or you're acting as executor for somebody else's, Heritage Trust can help. Partner with Heritage Trust to protect your family, your assets, and your legacy.
If you would like more information about Heritage Trust, please visit our website at heritagetrustcompany.ca.
This podcast is produced by Podfather Creative.